Hello, this is Chad McMahon with Protect with Insurance here in beautiful Prescott Valley, Arizona, talking about life insurance. And I just got out of an appointment with my friends and clients, Tim and Dana. And one of their questions during the appointment was, what is better for me? What is better for us? Whole life or term? And what should we do? What's going to give us the best benefit? And so here are some of the quick differences, and then I'll elaborate just a little bit. Quick differences: whole life, there are a lot of advantages and there are a couple disadvantages of whole life. The advantages are whole life is never going to expire. In some ways, it's the best kind of a life insurance that there is. It's never going to expire. It's never going to change in, at least it never should, change in price, change in coverage. Assuming it's a level policy, meaning it's never going to increase or decrease. And they're fantastic. You know, they also accrue a cash value, which should only ever be seen as an emergency fund. If you pull out money out of the cash value in your whole life policy, that's less money that will be for the death benefit. So if it's $20,000 whole life policy and you pull out $5,000, now the death benefit is going to be roughly $15,000. You can always pay that money back in, and then it's a $20,000 policy again. But that cash value is very handy. If you have an emergency that comes up, it's a wonderful thing. Now, the main disadvantage of a whole life policy is that they are generally smaller policies, between $5,000 and about $40,000 in coverage. There are exceptions to that. There are larger whole life policies. I have access to many options, but they're more expensive. You know, you're looking at a policy that's never going to expire. Then the insurance company is taking on a grand majority of the risk. They're saying, this policy we're going to guarantee until death without any exception at all. It's a full coverage policy. So if the insurance company is going to do a larger policy, let's say $100,000 or $300,000, it's going to cost a lot more. And that's just common sense. The other type of policy is a term policy. Now, term policies are usually larger coverage policies, which makes them very handy for things like mortgage protection, you know, a life insurance policy that'll pay off the mortgage in the event of a death. It's a great way to secure your family. A lot of my clients are, let's say, even younger couples with kids. A term policy is going to be ideal. Maybe a larger policy, $300,000, $400,000, $500,000 policy. Even if it's a $200,000 policy, something larger, if something happens, it can either A, again, pay off that mortgage, or B, just be money that's going to be much needed in the event of a death. You get one person's income that disappears. I know this is awful stuff to hear, but this is real stuff and it's important to talk about and at least consider. So if you get that income that disappears, not only is that going to make life a lot harder financially and otherwise, but when you lose a loved one, it makes decision making almost impossible. So something like not being able to afford your bills is unbearable. And so having that bigger check come in is obviously, it's a big deal. It's not just money. It's a much, much bigger deal than that. And that's why this is such an important thing. The downsides of term policies is that they do expire. There's no cash value. Most terms, not all, when they expire, that's it. You have to get reinsured. And at that point, term probably won't be an option. Typically, term policies are going to be 10, 15, 20, 25, or 30-year policies, depending upon your age and depending upon what's affordable. The longer the term, the more expensive it's going to be in terms of a monthly cost or an annual cost or quarterly cost. Those are the key highlights on that. Now, oftentimes, but again, not always, there are always exceptions to this. You need to talk about this with your agent. A lot of times these term policies are going to have some amazing living benefits built in as well. They're designed for people that are younger and are looking to insure themselves not permanently for a long period of time. So 20, 30 years is most common. So a lot of these term policies, not all, but a lot of them are going to have these living benefits built in. So if they have an issue with disability, if they have an issue, a health problem that's significant, something like that, these policies can pay somewhat or pay entirely while they're alive. And that is hugely helpful. You know, get that mortgage just paid off while they're still around and still alive. That's a big deal. So make sure that you ask about that when you're sitting down with someone to get more information. That is the quick of it. And if you have more questions, please, folks, reach out to me. I'm happy to help you. You can also call me directly. But anytime that you comment on videos, we'll take a look at that. We'll get to it. And if you ask for videos on things, we'll be happy to provide them. All right, everyone. This is again Chad McMahon with Protect with Insurance, and signing off. Take care.